Welcome to today's discussion on crypto exchanges, focusing on the differences between centralized and decentralized platforms. We'll dive into how they work and what makes each one tick.
I'm really excited about this. There's a lot to unpack, especially around how control and security differ, right?
Absolutely. Yep. You see, centralized exchanges are like big digital platforms that act as intermediaries between buyers and sellers, holding private keys and managing the trading process for you. They basically operate as the custodians of your funds.
Right. And these platforms, like Binance or Coinbase, give you that user-friendly feel, making it easier even for first-timers to get involved.
Exactly. They provide clean, intuitive interfaces and a wide range of cryptocurrencies to choose from, which really boosts liquidity and trading volume. That liquidity is crucial for executing trades without big price impacts.
Speaking of liquidity, isn't it interesting how centralized exchanges usually leverage market makers to steady the trading environment?
Yes. Market makers help maintain competitive spreads and overall market stability. But here's a catch. Because these exchanges control the private keys, users are temporarily giving up full control of their assets.
Right, and that's a double-edged sword. On one hand, regulatory oversight and higher liquidity. On the other, potential risks if the platform is hacked or engages in unethical practices.
Exactly. And a lot of these platforms require you to undergo rigorous know your customer processes. Now, while this boosts regulatory compliance, making them appealing for institutional investors, it also means there's a loss of complete anonymity.
Yep, true. And that's where decentralized exchanges really stand apart. They let you trade directly peer-to-peer with no central authority keeping tabs, right?
Precisely. Decentralized exchanges, or DEX, let users control their own private keys, giving them full ownership of funds. It's like you're the boss of your wallet.
And because of that, there's no KYC requirement, which means you can maintain your anonymity throughout. But doesn't that also come with some pitfalls?
It does. While lower fees and the empowerment of users are definitely pluses, DEX usually suffer from lower liquidity compared to their centralized counterparts. That can lead to bigger spreads and more price volatility.
Plus, the technical hurdles are higher. For instance, if you're not used to managing your own keys or dealing with gas fees, it can be quite intimidating.
Exactly. It's like trying to ride a bike with training wheels removed too early. You need some expertise, or you might end up wiping out and losing funds due to technical mistakes.
Right, and the decentralized model also means there's often little to no customer support when things go wrong. That might put off less experienced users.
True. And while DEXs offer strong resistance to censorship, pretty important for users in restrictive regions, they're also more vulnerable to market manipulation in some cases due to the lack of centralized oversight.
I get that, but don't you think that the lack of regulation on DEXs might actually be a plus for those who prioritize freedom over safety?
That's a good point. But here's where I respectfully challenge it. While freedom and anonymity are great, the absence of regulation also attracts illicit activities like money laundering, which could hurt the broader crypto ecosystem.
I see what you're saying. There's a balance to be struck between security and freedom.
Exactly. And speaking of balance, centralized exchanges are also facing their own set of regulatory challenges. With stringent licensing requirements and compliance measures, sometimes the range of supported tokens gets limited.
Right. Yep. And we've seen high-profile hacks targeting these centralized platforms, leading to massive losses. The risks are significant when everything is stored in one place.
Precisely. And this centralization of risk is a critical concept. It's like putting all your eggs in one basket. If that basket drops, you're in trouble.
So, in a way, both models have trade-offs. Centralized exchanges offer convenience and liquidity, but at the cost of security and, autonomy over your funds.
Right. And DEX restore that control to you, though at the expense of ease of use and liquidity. Also, the technical hurdles mean that only those comfortable with blockchain tech tend to flourish there.
Yep. It's interesting to note that many are predicting future trends. With increasing mainstream adoption, both models are likely to evolve. How do you see that playing out?
Well, the future seems to be about integration. Increasingly, we'll see regulatory frameworks adapt to crypto exchanges, which might help centralize security without stifling innovation.
And on the decentralized side, I think we'll see improvements in user experience, maybe with better interfaces and more liquidity pooling mechanisms than we have now.
Yeah, exactly. Innovations like liquidity mining and enhanced smart contract designs could bridge the gap a bit, making DEXs more attractive to average users without losing their inherent benefits.
So it sounds like the future is really a blend, taking the best elements from both sides.
That's right. As regulations become clearer and technology advances, the line between centralized and decentralized might blur, offering users greater choice and improved security overall.
Yeah. One angle I find fascinating is the idea of decentralized finance, or DeFi. These models are built on decentralized exchanges and allow users to lend, borrow, or even earn passive income from staking.
Absolutely. DeFi platforms are something else. They shift the financial services paradigm entirely. Instead of relying on traditional banks, these platforms use smart contracts to facilitate transactions, and the fees are often much lower.
But again, with that innovation comes risk. Without centralized oversight, if a smart contract fails or gets exploited, the users have to bear the brunt of it.
Exactly, and that's a real concern. While the decentralized model empowers, it also requires users to be more vigilant about security and technical details.
And that might mean that new users could be at a disadvantage or worse, lose funds due to inexperience.
True. So, for newcomers stepping into crypto, centralized exchanges might offer a gentler learning curve despite their risks because of the robust support system and the broad variety of services provided.
While more experienced traders might lean towards DEX, enjoying the benefits of controlling their own keys and making anonymous transactions.
Precisely, it boils down to what the user values more: ease of use and liquidity versus privacy and control.
And it's really not a one-size-fits-all, is it? Each type has its merits based on different user needs.
Right. The interplay between these two models is a perfect example of how the crypto space is balancing innovation with risk management. Not to mention, both types really have room to grow as technology and regulations evolve.
I also see that decentralized exchanges could benefit from integrating some customer support systems without compromising their core decentralized nature. It's a tough balance, though.
Exactly. It's a point of contention. While pure decentralization champions complete self-custody, adding layers of support might require a hybrid approach, possibly even mimicking some centralized features without losing the core ethos.
That makes sense. Overall, it's a dynamic environment where protection of funds, regulatory compliance, and user experience are constantly in flux. It's like a complex ecosystem that just keeps evolving.
Absolutely. And that's what makes following these developments so exciting. Whether you gravitate towards centralized or decentralized, each offers compelling advantages and distinct challenges. The key is staying informed about the risks and rewards of your chosen path.
Yes, indeed.